All right. Hi, everyone. Welcome to today's webinar. My name is Martha, for those that are not familiar with me, but thank you so much for joining us today. We're still celebrating Financial Literacy Month, the month of April. So we have another great presentation today. And for anybody that is thinking about, maybe it's one of your goals of becoming a homeowner, we do have a presentation by Golden1 with Megan that I think will come in handy just for now and investing into our future. So Megan, I will go ahead and turn it over to you. Again, people, if you have any questions, go ahead and use the chat box or let us know throughout the presentation. We'll make sure to address your questions or any comments. So thank you everybody for being here.
Thank you for the introduction, Martha. I'm going to go ahead and share my screen. Hopefully you see my bubble here on the screen with my business picture here. My name is Megan Collifer, and I am Golden1 Credit Union's Community and Financial Education Specialist. And I want to welcome you today to our presentation on becoming a homeowner. Now, there's a lot of different reasons why you might be here today, right? Some of us might be thinking about buying a home or are still saving and just want to know a little bit more, but positioning yourself and understanding kind of everything that goes into home loans is a good stepping stone in the right direction. So today we're going to cover some different steps to home ownership and talk about some things that are available to not only Golden1, but possibly here in our community to assist you on this financial journey. To start, buying a home for the first time is a really exciting, but also kind of a scary step, right? It's scary because we hear horror stories, right? And we know that it is a lot of work. But buying a home is really just a series of defined steps, right? So first, we need to save for a down payment. We need to review our credit reports and boost our scores. We need to get pre-approved, hire an agent, search and choose a property, submit an offer and get accepted, plan and prepare for closing costs, sign closing documents, receive our keys, and eventually move in. Now, I know that this is a lot of steps, but don't worry, we're going to dive into each of these steps and address any questions that you may have as we go along the way. So once again, utilize that chat box. I'm also going to post my email address in the chat box for anybody that needs to reach out to us here. In terms of saving for home ownership, saving is an essential part of preparing for home ownership. And there are several things that you'll want to save for, including a down payment, closing costs, post-purchase expenses, and repairs and renovations. So a down payment, this will likely be your largest out-of-pocket expense. A down payment of at least 20% was commonly required in the past, but today a lot of lenders will accept a significantly less of a down payment, but they might put you into a loan that has like a private mortgage insurance or some other fees if you don't put at least that 20% down. Closing costs. Closing costs include all of the fees required to execute the home sale. Typically, these costs are 3 to 5% of the purchase price. You might have to pay these fees yourself, right? Or sometimes you can get the seller of the home to pay these fees. Now, we're in a really tough market right now. So I don't know if that type of negotiation is going to work in your favor, right? You might be stuck with paying that closing cost, either a portion of it or all of it. Of course, there is other great programs available that are out there that can help you with those closing costs or even down payment assistance, right? Golden1 Credit Union, for example, has a home Buyer Advantage program that helps you get in touch with a preferred real estate agent and offers a certain percentage back of this closing costs. If this is something that you're interested in, I encourage you to visit our financial institution's webpage under home loans, or tune in and listen to our Home Buyer Advantage Program podcast on Golden1's podcast station. In addition to a down payment and closing costs, there's also something called post-purchase reserve funds. Your lender, meaning who you get a loan with, might expect you to have some kind of savings left over after you purchase your home. This allows you to pay the mortgage even if there's some kind of thing that happens that experiences some kind of cash flow deduction, right? Or loss of cash flow. So in other words, if you buy your home and you're in your home and 3 weeks later, you know, knock on wood, you get laid off from work, right? You still have some money there to back and support your new mortgage while you get back on your feet. Post-purchase reserve funds often include costs for repairs, some renovations and furniture as well. Sometimes these post-purchase reserve funds are a lot that are required. Sometimes they're not very much, if any at all. It all depends on the lender itself. Now, if you're planning to buy a house soon and you have not saved anything yet, don't want this to discourage you, right? Of course, you need to save every which way you can, even if it's not much, because it's a good stepping stone in the right direction. But oftentimes lenders and different community resources do have resources available for down payment assistance as well as closing cost assistance. For example, a lot of first-time home buyers, they get down payment assistance, you know, from their parents or family members, or from the community or their financial institution. If you are someone that is receiving some kind of payment assistance from your parents or a family member, it's important to keep in mind that a lot of lenders have set rules regarding that down payment assistance. So if you are receiving money from, say, mom and dad, it usually needs to be disclosed that it's a gift and not a loan. Right? It also needs to come from a relative or a person that you have documented some kind of close relationship with, right? We can not accept large deposits into accounts without knowing where those deposits came from. So if you go to buy a home and all of a sudden, you know, we're looking at your statement and there's a big deposit of $5,000 in there, we need to know where that money came from. Right? So if that was a gift, if that's a loan, that's something that your lender is going to want to know in establishing whether or not you qualify for the loan. In terms of saving sources, there's a lot of things that you can do. Maybe you can automate some deductions coming out of your paycheck to help you save. We can look into that gift option if you have a relative or a family member willing to help you with that down payment. And you can also sell assets, right? Take a look around your home or your apartment and see if there's some things that you can sell to help free up some income, because every little bit is going to help here. If you're not quite ready and you don't have enough money for that down payment, it's okay, start saving. In the meantime, let's work on reviewing that credit report and making sure our credit scores are on point for that loan. Because in order to get a mortgage, especially one with a really good interest rate, you have to have a good credit score. Now, the FICO score is the most common scoring model, and scores range anywhere between 3 and 850 within that scoring model. The higher your score, the better chance you are for getting the better interest rate and qualifying for the loan. A lot of lenders do require a score of at least 620, but the market and the economy is kind of tough. So I've seen these requirements go up in terms of scores, right? So we're looking high 6s, low 7s before we're qualifying. If you are not quite ready to buy, you still should check out your credit score, right? Check it out, make sure that there's no funny business happening on that credit report. And if the score is low, well, this gives you some time to boost your credit score. And there's a lot of things that we can do to boost our credit score. The two most heavily weighted factors in the FICO score are your payment history and your level of debt. If you make a late payment, your score is going to take a hit. And the more recent, frequent, or severe the late payments are, the lower your score is going to be. So even if you make your payments on time, your score, it might be low if you carry large balances on revolving debt, especially credit cards, particularly if those credit card balances are close to the credit limit. In fact, we like to advise that you keep your usage below 50%, ideally 30% on those credit cards to maximize your credit score. So if you have a $10,000 credit card, you do not want to spend more than $5,000. The minute you have $5,001 as your outstanding balance, you're now on the other end of the spectrum, right? You're closer to maxing it out than you are paying it off. And that's why it has this deep-rooted connection to your credit score and can have a negative impact. If you don't know what your credit scores are, it's a good idea to check them well before you plan to purchase a home. Because when we improve these low scores, it takes time, right? It takes some time to fix them. If improving your low scores is taking a little too long, or they're not as high as you want them to be, there are some things that you can do. First, make your payments on time. If your balances are high, maybe you focus on paying them down below that 50% mark, and then from there, tackle the one with the highest interest rate first. And remember, time is your friend here. What's happened in the past 2 years has more of an impact than what happened before that. So even after 7 years has passed, most negative information is removed from your credit report. So we do have time on our side. Even if you think that you have perfect credit, you should still check your credit reports at least 60 days before applying for a mortgage, because there might be some errors on there, right? So be mindful of that. Your credit report sometimes isn't perfect, right? Maybe they have an address that's not correct, or somebody transposed your social security number along the line. These are things that you would really benefit from correcting before you start engaging in a really hefty purchase like that of a home loan. All right, so getting the mortgage loan. Before you make an offer on a home, you can either be pre-approved or pre-qualified by a lender. These are two different things, pre-approval or pre-qualification. With a pre-qualification, you are given an estimate of what you can afford. When you're pre-approved, this is where you get a commitment from the lender to provide a mortgage for up to a certain amount. Of course, if there's major financial changes, then that might change. So why do we think we might want to get pre-approved before making an offer instead of waiting until after to apply for a mortgage? Well, there's a couple reasons for that. First, it lets sellers know that you're a serious buyer. A lot of sellers will not consider offers from those without a pre-approval, especially in this market. It also gives you a limit as to which homes to look at, right? Why put an offer on a house that requires a $500,000 mortgage if you can only get a $300,000 loan for a mortgage, right? We don't want to go shopping for things that we can't afford. So that's why it's so important to go through this process and make sure that you do get pre-approved. Now, a lot of lenders consider a lot of different factors when deciding whether or not to approve a loan and how much to approve you for. A lot of times, these things include things like your credit score that we've already discussed, assets, including your down payment amount, right? Lenders typically set a maximum what they call loan to value ratio, which determines how much of the home purchase can actually be financed by the mortgage and how much must be financed by the down payment. So if the lender's maximum loan to value ratio is 95%, then that means you have to provide that other 5% as a down payment. Another big factor that lenders look at is your employment history. In order to know that you are capable of paying a mortgage, lenders usually want to see at least 2 years of consistent employment in the same field. Now, we did just come out of a pandemic. Some would argue that we are still in it. And we saw a lot of variables playing into people's employment, right? People were let go, picked up, dropped half part-time, went on to from salary to hourly. Lots of different things happened. So your lenders are very aware of that. So that's why they're going to look often past that 2-year time frame to see what else you've been up to, right? So be aware of that. If they're asking for more employment history because of something that happened within the past 2 years, that's why they're doing it, right? They're on your side to help you get qualified for that loan. In addition to your employment history, your income is something that is going to be examined. Traditionally, lenders have required that the mortgage payments, including taxes and insurance, these don't exceed 28 to 33% of your gross income, right? But in recent years, because of the cost of living in California, I've seen a lot of lenders that have raised that ratio. I just caution you all with this because we don't want to become what we call house poor, right? We don't want all of our income going to a mortgage. We still need to be able to, afford transportation and food and hopefully some extracurricular activities, right? We want to be able to go to the movies and buy a bag of popcorn, not just paying everything that we earn towards our mortgage, right? So once again, that percentage, including taxes and insurance, they don't want you to go over 28 to 33% of your gross income. In terms of your existing debt, a lot of lenders have traditionally required that your existing debt payments plus your mortgage payment not exceed 36 to 38% of your gross income. Okay, so debt really plays a factor in qualifying you for a loan. And the availability of that credit limit also plays a factor in qualifying you for the loan. So for example, if you have 10 credit cards and you recently paid them all off, that's going to show on your credit report. And now your lender is going to look at you and say, okay, Megan, if we qualify you for this loan and you turn around and you max out all 10 of those credit cards again, are you still going to be able to afford this new monthly mortgage payment as well as the payments on this credit cards? And if the answer is no, then you might not qualify for the loan, or you might qualify for a lesser amount. So be conscious of that as well. We don't want to have too many lines open, but we do want some credit history there to back and support our credit worthiness and our history that shows that we're good for payments, right? That we know how to make payments and we make them on time. After your lender collects all this necessary information, the lender will either approve your loan or they will deny it. If the loan is approved, the lender is going to tell you an amount that you can borrow and what the interest rate is. Because lenders adjust their interest rates frequently, the rate that you are given at approval is not necessarily going to be your actual interest rate. Your actual interest rate is determined at closing, which is usually 30 days after you make and get approved for your home, right? A lot of lenders offer an option of locking in the interest rate you're given at approval, but most kind of charge a fee for this service, but some don't, right? I would encourage everyone to lock their interest rate. We've seen prime or interest rates and inflation really play a factor in home loans recently, right? We've seen interest rates, go up quite a bit and change sometimes on the daily. And they all seem to be going in the upward direction. So locking in at a lower interest rate might be worth the extra expense if they are charging a fee for that particular service. Typically within 3 business days of receiving your loan application, a lender must give you a loan estimate. This is going to show the amount that you're going to finance, the total amount that needs to be paid back over the life of the loan, your annual percentage rate, any kind of finance charges you'll have, the total number of payments, the amount of the payments, and include a late payment policy and a prepayment penalty if there is any. The loan estimate itself also includes lenders' estimation of those closing costs that I've mentioned. So be sure to read it carefully and ask for clarification from the lender if you have any questions. Now, in terms of types of mortgages, there's a lot of different types there. Okay, so I'm going to try and go over some of the basic types of mortgages that are available. But once again, there is a lot of different kinds of mortgages that are available, and it would be impossible for me to cover all of that inside this presentation. But I do want to cover some of the basics. The first is what we call a fixed rate mortgage. Fixed rate mortgages come with an interest rate that remains consistent over the life of the loan. It's not going to change. That's your interest rate, right? For that loan. Now, if you refinance it, you might have a different interest rate, right? Because it's a new loan to replace your existing one. But with a fixed rate mortgage, the interest rate is usually initially higher than for other types of mortgages, right? But because the interest rate and the payments are fixed, they provide a stability that's really appealing to a lot of buyers. Most mortgages are fixed rate mortgages of some kind, but there are other types of loans that are out there. Some of you may or may not have heard of an adjustable rate mortgage or an ARM mortgage. These were really, really popular around 2005 to 2007. And when these rates adjusted, we saw a lot of foreclosures and things happening, right? So an adjustable rate mortgage. We also refer to these as ARMs. And what these loans are is they have a period of fixed interest. But once that period ends, the interest rate and the payment adjusts at specific intervals, right? It's not going to go from, 2% to 10% overnight, but they will start adjusting in intervals until they get to whatever the current interest rate is. So in general, what happens with these loans is that the interest rate and the monthly payment for an ARM start off really low, a lot lower than, say, for a fixed rate mortgage for the same amount. But they often become higher once a few adjustments occur. An ARM might be a really good option for people who plan to sell in a few years or expect that their income is going to increase significantly. But once again, an ARM can be very risky. And we saw a lot of this, like I said, a little over a decade ago, with a lot of foreclosures and people being upside down on their loans or no longer being able to afford the monthly payment. Another really common type of mortgage is what we call an interest-only mortgage. With an interest-only mortgage, you pay just the interest for a specific period of time, usually between 3 and 10 years. Once that period is over, the payment rises to include both the principal and the interest. That initial payment is lower than for a fixed rate mortgage because you're not paying anything on principal. But once the interest only period is over, the monthly payment becomes higher because you are paying down the principal, and generally you're paying it down in a shorter period of time. Like an ARM loan, there is a risk that you're not going to be able to afford the mortgage once the payments increase. But once again, these interest-only mortgages can be very beneficial if you think you're going to be moving within a short period of time, or if you know that your income is going to significantly increase once that that specific period of time for the interest-only mortgage ends. Now, the payments and what actually goes into the mortgage. Once you buy a house, you have to start making mortgage payments. So I want to go over with you what exactly is happening with the money that you send to your lender every month for this mortgage. Most of your payment is repaying the mortgage loan, right? And loan payments can be divided into both principal and interest. With most mortgages, all the payments that you start up at the beginning of the loan, a lot of that goes to interest. But as you continue to make payments, a higher percentage will start to go towards principal. This process of making payments and more of it going towards the principal or the amount you initially took out is called amortization, right? It's the fancy term that these lenders use. Now, part of your payment may consist of money the lender collects on your behalf for property taxes, homeowner insurance, and in some cases, private mortgage insurance. Okay. Private mortgage insurance, or PMI, protects the lender against loss if you default on the loan. And this is typically something that's added to loans if you're not putting that full 20% down payment. Right? So if you're not putting that full 20% down, a lot of lenders think that you're not as invested in the property, right? You haven't put as much money into it, so it's easier for you to walk away. So that's why they charge this PMI. And we see a lot of first-time home buyers not get conventional loans, right? They usually get an FHA loan, right? And it will have this PMI insurance in there. Every month when the lender puts aside money for these expenses, they're held in something that's called an escrow account, right? And a lot of times this escrow account is all factored into what it is that you're paying, every month towards your loan. You usually have your mortgage payment and your escrow payment. And then escrow takes care of all of these extras for you, right? They take care of the taxes and the homeowner's insurance. They take care of making sure all of those parties get paid. So that way you only have to pay, one party a month when you pay your mortgage. Now, some people prefer not to have an escrow account and they'd rather, pay AAA or whoever their insurance is once a year for their homeowner's insurance, and that's an option. I've also seen people say, you know what, I want to pay my own property taxes. And so your property taxes come twice a year. You get a bill in the mail and they pay them on their own. But if you're like me, I'm like, no, I don't want to manage all those bills. The less I have to do, the better. Then you have an escrow account, right? You make a payment, some of it goes to your mortgage, the rest goes in the escrow account, and they take care of the rest. Now, I do want to throw out this red flag for you because I've seen it unfortunately happen quite a few times lately. But if you have an escrow account with that takes care of your property taxes, you will still receive a bill from the county clerk's office. You'll still receive something regarding property taxes. If you have an escrow account, know that that is being paid out of the escrow account. Sure, you can do your follow-up, but don't double pay it, right? Don't have the escrow company pay it and you pay it, because getting a refund for that is really tough, right? They usually just forward it to the next year, and it can be a significant dollar amount, right? It can be thousands of dollars, really, especially because property taxes are so high here in California. So just be careful with that. Okay, so that is your mortgage payment components. Now, once you're pre-qualified or you're pre-approved for a mortgage, you're ready to start your home search. And there are several steps that you can take to find a real estate agent that you'll be happy with, right? And a real estate agent is a really important person in your corner, because this mortgage stuff can be a lot. Right? It's a lot of information, a lot to understand, and we don't need to be the experts. That's why we have real estate agents, right? They're here to help. So in order to find a great agent, ask for some referrals. Many of your friends and relatives have probably bought and sold their homes through real estate agents. You might also want to search by area. You can find out which real estate agents specialize in the kind of home or area you want by looking in the phone book, online, or in the newspaper, real estate classified ads. You can also drive through your desired neighborhoods and note, the names on the for sale signs. It's also a good idea to comparison shop. Talk to several prospective real estate agents and ask questions about the areas and types of homes you're interested in. Do they seem knowledgeable? Is their personal style a good fit with your own? Remember, you're the boss here, right? So you can decide who you want to work with. And by all means, please avoid using the seller's real estate agent, right? Don't go to an open house and use the open house agent as your agent to buy that house, because a real estate agent that's working for you and the seller, he or she is not really able to be an advocate for you because they're trying to work both sides of the negotiations, right? So make sure you have your own person negotiating for you. And once again, if you need help obtaining a real estate agent, Golden1 Credit Union's Home Buyer Advantage program is worth the inquiry. When you're buying a home, there are several types of homes to choose from, and no one type is right for everyone. So look at your lifestyle and your preferences when deciding what to choose. The most common types of homes are what we call single family residence. You own the house and the land around it, and you're not restricted by any rules, and you're solely responsible for maintaining the home. Versus a duplex or a multi-unit building. It's similar to a single family home, only you own more than one legally divided unit. Planned unit development means that you own the house and the land directly around it, but the development as a whole is owned by the residents. And generally there are restrictions as to what you can do outside of your house. Right? These are where we get a lot of people with homeowner associations, right? In those planned unit developments. Now with a condominium, condos consist of multiple units in one building. You own the interior of your condo, and the building as a whole is owned by that homeowners association or HOA, which consists of all of the unit's owners. The HOA is responsible for maintaining the physical structure of the building, but you often have to pay some kind of HOA dues and follow the community rules. Condos themselves are usually cheaper than single family residences as well. Townhouses. Townhouses are similar to condos in that there is typically that HOA and the units are attached, but with a townhouse, you own the complex unit, including the roof, exterior walls, and the land it sits on. Manufactured housing. Manufactured housing is built, in a factory, and it's kind of shipped to the location where it's going to be placed. And depending on the community, you might own the land underneath the unit, or you might pay rent for, say, a lot. Generally, manufactured housing is less expensive than some of these other options. And finally, cooperative housing. In a co-op, you purchase shares in a corporation that owns the property. So purchasing the shares allows you to reside in a unit, but you do not individually own the unit you live in. So like condos, you have to pay HOA dues and follow the community rules, but co-ops tend to be cheaper than condos. However, in order to purchase a co-op, you're often required to put down a large down payment and be approved by a co-op board of people. So consider what is affordable when you're purchasing a home. By taking the time to examine your finances and really see what you can afford, you can enjoy your home and not have to worry about where the money will come from to pay the mortgage. What you are pre-approved or pre-qualified for is not necessarily the same thing as what you can afford. Remember to create a budget because it's going to give you a better idea of what you can afford. And keep your housing allowance in mind when you're searching for that home. Because when you see a house you like, calculate what it's going to cost you per month and calculate the loan payment. You can use a mortgage, payment table or calculator. Those are available. And remember to consider the non-loan housing costs too, like your property taxes, that home insurance, maintenance, right? All those other different possibilities, PMI, HOA dues, water, sewer, and garbage. Those things aren't usually included, right? Like they are with renting. So all of those need to be factored into what exactly you can afford for that mortgage payment. Obviously, price is one of the most important features of a home, but it's definitely not the only one. Your housing search will be more efficient and focused if you think beforehand about what you really want in your home. Most first-time home buyer budgets are limited, so you might not be able to get everything you want. So really weigh out what is most important to you. How can you find homes? Well, first and foremost, a real estate agent. He or she can see what is listed on something called a multiple listing service or MLS. You can also drive around the neighborhoods you're interested in and look for sale signs. I know my husband and I had to do this when we were looking for a home, and we figured out what homes were for sale based on the pod delivery services, people loading up their houses into pods before they moved. Sometimes you have to have that much initiative in order to know when that house is going to hit the market. Once the house does become marketable, then your real estate agent can bring you to an open house or arrange showings at another time. When you're searching for a home, try to avoid being distracted by things that are easy to change, right? Like paint, for example. I know when I walked into my home, I had a tie-dye wall in my house, right? Very discouraging for a lot of home buyers. But I told myself, a gallon of paint is not that expensive. I can fix it, right? So just remember that you can change things. And if you look at a lot of houses, sometimes this happens and it can be easy for them to kind of start blending together. Take some pictures, maybe film it. Keep a checklist of what your wants are for the house, and check off the features of the house. That way it'll help you remember and review options when you are considering multiple homes. For any homes that you are considering making an offer on, try to visit that home more than once during different times of the day. This way you'll know if, for example, your neighbors are loud at night or traffic is super heavy during the day, right? Visit it at different times. That way it can help you figure out if you're really making a wise investment. And if you're interested in a condo or some other type of development with a homeowners association, it's really beneficial to research it, right? The home's MLS listing should show the HOA dues, and you should be able to get the community's bylaws and financial statements from the seller before you make that offer. Sorry, I got ahead of myself and wasn't clicking. Other components of an offer. Once you find the house you want to purchase, your real estate agent will prepare an offer. Offers typically have at least 3 components: the price, the closing date, and how long the offer is good for. A lot of offers have additional components such as concessions, inclusions, and contingencies. Seller concessions, these are costs that the seller pays for the buyer, and this ultimately reduces the amount of money the seller receives. Inclusions refer to what stays in the house. So if you want the appliances, the blinds, the chandeliers, or anything else to say, make sure you're putting that in the offer. And contingencies, these things refer to the conditions that must be met for the sale of the house to go through. For example, if you notice that there's a termite issue, that might be something you want to have resolved before you move into the house, right? In order for the loan to go through. A home inspection, for example, is a type of contingency. So having the inspection allows you to renegotiate with the seller if there is some kind of problem. A financing contingency, financing contingencies are typically things that need to be taken care of in order to find financing for a mortgage. So this is in addition to that pre-approval, because pre-approvals are sometimes revoked if something pops up in a home inspection or when they're taking a closer look at your finances. An appraisal contingency, your lender will likely require you to include this to ensure that the sale price is not overinflated. In other words, if your home is only worth, that you're buying is worth $300,000, but you wrote an offer for $400,000, you might not be able to get a loan for that dollar amount because the home is not worth that, right? So you might have to renegotiate or put a larger down payment in order to obtain that mortgage. Your real estate agent, once this offer is made up, is going to present the offer to the seller and the agent. And then along with the offer, it's usually customary that the seller provides earnest money. Usually this is between 1% and 3% of the offered price, but it can kind of vary from place to place. And this money is part of the down payment. Right? So what this does is it shows the seller that you are serious about purchasing the house, right? So this is something that definitely works in your favor if you're looking to purchase a home, right? Offer some earnest money. Now the seller will either accept your offer, they'll counter the offer, or reject the offer. If the seller accepts, the house is taken off the market and the offer becomes a binding contract. When the seller counters, usually it's with, a higher purchase price, but they could also counter on, the closing date or some of these concessions, inclusions, and contingencies, right? Just because they counter doesn't mean that you need to accept. You can counter back as well. So just remember, it's all part of the negotiation process. And hopefully your real estate agent will be there to help you with that process. Once your offer is accepted, this is when you can arrange for home inspections, which should be done by an independent qualified professional, and either apply for a mortgage if you haven't already done so, or let your lender know that you found a home if you were pre-approved. And what that lender will do is start preparing for closing. This is also the time for you to avoid taking on additional debt before closing. Just because you're in a binding contract does not mean that something might not happen with that loan, right? So now is not the time to go furniture shopping. You do not go furniture shopping until you get your keys in hand. This would also be a really bad time to say, get a loan or buy a car, right? When you're in this contract, don't do anything with your finances, because every little thing that you do is going to have to be checked out by the lender. So please don't make any major changes to your finances. You'll also have to make some choices on how you're going to qualify or how you're going to place the deed of the home. So for example, if you're buying the house with another person, or both of your names going to be on it, if mom and dad are helping to buy the house with you, or their name's going to be on the deed. So you'll have to make some decisions on how to classify that title. And then finally, about a day or so before closing, it's a really good idea to do a final walkthrough of the property to make sure that the seller did not take anything that they were supposed to leave, and that the property is in the same condition it was before. Now, I just helped a friend of mine move into a home that had hardwood floors, and the seller decided to drag furniture across the hardwood floors when they were moving, and it destroyed the floors, right? And so that was something that due before the final walkthrough. They saw that in the final walkthrough and said, you're not going to get paid until this is resolved, until this is fixed. And the seller did have to fix the floors before the home sale was finalized. So that's why those final walkthroughs are so important. Now, finally, closing day, right? Closing is the day that the mortgage is finalized and the title of the house is transferred to you. In a lot of states, the closing is handled by the title company. If not, it might be handled by a closing company or an attorney. The closing disclosure lists your actual closing cost, and it's usually provided 3 days prior to closing. That way you have time to review it. At closing, you'll probably need photo identification, proof of insurance on the home, and a cashier's check for the amount that you're paying for closing costs and the down payment. Sometimes those things are also required to be done via wire. So you'll need to make sure that your financial institution is open on the day that that needs to happen. After you sign all the documents, you will then receive the keys to your new home and become a homeowner, right? Just remember, getting a mortgage, it's not free. Besides the interest you got to pay each month, you usually have to pay fees to close that loan and transfer the home from the seller to you. And the lender is required to give you an estimate of these closing costs called a good faith estimate. Once again, that's usually done 3 business days before you receive that rest of that loan application. And closing costs can include a lot of things, like a loan origination fee. This is the fee for processing and providing your loan. You might also be paying for points, right? Points are extra things you pay to the loan to help buy down your interest rate, right? So your interest rate's not as high. You might also have to pay for a title search and title insurance. This ensures that the person that's selling you the house is actually the owner of the house and that there's no liens against the property, right? It means they're okay to actually sell you the house to begin with. An appraisal, that lender might require an appraisal of the house to ensure that they're not lending you more than its market value. You might have to have a survey done. A survey confirms the legal recorded boundaries of the property. This is very common, especially if you're buying a home out in the country, right? You might need to have a survey done. A recording fee, this is a fee that is charged to record the transfer of ownership down at the county clerk office, right? It takes paperwork and they want money for that paperwork. So the recording fee. And finally, the last term here, mortgage interest. At closing, you'll likely have to pay the interest that will accrue on the mortgage between the closing date and that first payment date, right? So you might have a mini payment in there depending on when your loan closes. Tax benefits of home ownership. I'm just going to briefly touch on these. There is some tax deductions that can help reduce your taxable income. You might be able to write off mortgage interest, property taxes, that private mortgage insurance, and any points that you buy to buy down the cost of the loan. You'll also want to look into revising your W-4 to see if you can reduce tax withholdings from your paycheck as well. Right, so lots of different things for taxes when you buy a home. Now, I know I've gone over oodles of information. I do want to point you in the direction of some additional resources. Golden1 Credit Union does have a slew of online videos, short tutorial videos. We offer webinars similar to the one that you're on today that talk about home ownership, but we have them on many different topics. We have a podcast station. We just recently released quite a few podcasts on home ownership. So I encourage you to check that out. We release about 2 podcasts a month on different topics. So lots of great resources. And then we do have something called a learning lab. I will let you in on a little secret. Our learning lab is getting ready to do a big fresh relaunch with a ton of new content and on a new platform. Probably the beginning of May now, or the middle of May. So stay tuned for that. Be on the lookout for that. It's going to have a lot of great resources to help you on this path to home ownership. I'll stick around for just a few more minutes in case anyone has any questions. I haven't seen anything pop up in the chat, but I want to thank you for being here today. And hopefully you learned a little bit about home ownership.
Thank you so much, Megan. Thank you, everybody, for joining us. I don't think anybody has any questions, but I did put in the chat box one of our events that we're partnering up with Megan and her team from Golden1. It's going to be next Tuesday, April 25th at 5 p.m. It's going to be at the library upstairs, room 2206. So we're really excited because if you want to practice budgeting, this is going to be an interactive simulation. So everybody will be given like a mock identity, and you'll get to travel through different stations to make sure that you budget within your means. So please join us. I put the link in there, and then there'll be pizza provided. There'll be some awesome raffle prizes that you guys could join us. Hopefully you're able to sign up by this Friday. But if you have any questions, I'll put my contact information in the chat box. I know somebody asked about documentation. I am taking attendance, so don't worry about it. Everybody will get credit for attendance today's webinar. Okay.
Thank you, everyone.
Okay. Thank you.